4-year-old startup, so you're very much part of that tech disruptive scene. You are disrupting the single-family rental industry. What is the specific problem you're trying to solve?
Well, accessibility, really. I mean, in the Bay Area, as we were chatting about earlier, it's quite expensive. So a lot of our investors live in the Bay Area and are renting, or we're looking for investment properties locally, and we're really priced out of the market. And so what we're doing is really a couple things with Roofstock: breaking down the geographic barriers to investing and making it more accessible by solving those last mile issues of operations. So with our latest product, Roofstock One, the properties are fully managed, and it's totally passive for investors. So for people who want to be less involved on the operations side and geographically diversified, it's a good product.
At the moment, talking geographical diversification, Atlanta, Indianapolis is where it's launched.
Yes.
Why there, and where next?
I thought you were going to ask me if I was actually from Indiana, which I am. That's not why we're launching. Both of those markets are very interesting single-family rental markets. They're affordable, so you can buy a lot of house for $100,000 or $200,000, and the rental yields are quite good. So they tend to run high occupancies, and they're good markets to operate in. And so it's just from a good balance perspective, a good way that we could offer, $5,000 shares by offering 10 shares of the equity.
And part of your pitch is that investors can treat these real estate investments as they would a portfolio of stocks. Mm-hmm. Stocks, of course, are very liquid. How do you ensure liquidity? How quickly can investors get in and out of their stakes?
Yeah, sure. Well, first of all, homes are the most liquid real estate, of the real estate assets. With ours, what we're doing is we're actually in the process of setting up a secondary market for the equity shares. Mm-hmm. So after 6 months, you'll be able to sell them.
To people on the platform?
Yeah, to people through the platform. So what's nice about the way that this investment is structured is once the property is initially put into the trust, it never trades again. So you don't have all the leakage associated with a typical real estate transaction, title insurance, transfer taxes, things like that. You're just literally trading the equity. So it squeezes out a lot of the cost and the friction of a traditional real estate transaction.
So in your pitch, it says radically accessible and enable investors to build wealth through real estate. How radically accessible are you? Because we were debating quite what an accredited investor really means.
Right. Well, there's a technical definition of an accredited investor, which all of us know. I think it's a couple $100,000 of income and a certain net worth requirement.
$200,000 in each of the prior 2 years,
yes.
Or $300,000 with a spouse, and can expect similar income going forward, or net worth of over $1 million.
Yeah.
How radically?
Well, I think what's radical about it is you could own property effectively for $5,000 slivers. So you don't have to, if you have, say, $50,000 to invest, you can invest across 5 or 10 homes, perhaps in different markets, and get that diversified exposure as opposed to being on title and having all the attendant responsibilities of being a landlord or property owner.
Now, you say returns may come in the form of potential dividends, tax benefits associated with ownership, and price appreciation. What's the best way for investors to benchmark themselves? Should they be benchmarking themselves against the median price increase of Indianapolis or Atlanta? How do you suggest they look at whether they're doing well versus where they want to be?
Yeah. So I think what's interesting about single-family rental homes, kind of broadly defined, they've had pretty similar returns to equities over time, with about 9% or so by our data over the long term, with much less volatility, and they lack correlation to equity. So I like to think about it as sort of an inflation index bond with an equity kicker, because you could increase your rent every year with inflation because they're annual leases. And then you have leverage typically against the home, and you get levered exposure to home price appreciation, and that's the sort of the equity kicker. So I think it's for people who are looking for kind of an amalgamation of bonds and stocks. So you do get a nice debt or yield that's similar to debt in kicking off dividends, but also upside. As opposed to being a bond, you've actually got the equity upside in the form of the equity.
We've got about 30 seconds left. Is there any way that anyone earning less than 200,000 can ever get in on this? Because that's still an affordability issue.
Absolutely. Well, on our typical marketplace, there's no requirement. So if you go to roofstock.com, we've got hundreds of homes for sale, which you could buy for as little as $20,000 and finance the rest with Fannie and Freddie loans. And over time, we hope to make this product available